Does it ever feel like you're a marketing professional just speaking into the void? Well, with LinkedIn ads, you can know you're reaching the right decision makers. You can even target buyers by job title, industry, company, seniority, skills. Wait, did I say job title yet? Get started today and see how you can avoid the void and reach the right buyers with LinkedIn ads. We'll even give you a $100 credit on your next campaign. Get started at linkedin.com/results. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
Tom is pushing buttons. Quit pushing buttons. Don't touch things. Hi, everybody. Welcome to the Talking Real Money podcast, where Tom is not allowed to touch the buttons on the screen. Should I raise my hand? No, Tom, you're a host. You don't have to raise your hand. Welcome to the show. I'm Don McDonald. Tom is over there. Don't touch any buttons.
I think that should just be the general rule for anything in my life.
Anything in your life.
Probably, because I'll blow it up. You know that.
And you know, it fits kind of with the general theme of today's podcast. Because we consider ourselves, human beings, Homo sapiens, we consider ourselves to be, as far as we know, the smartest form of life in the universe, as far as we know. We're certainly, well, we consider ourselves to be the most intelligent form of life on planet Earth or in our solar system, right? We're smart, right? We have big brains, right?
I haven't met anybody else or anything else that would suggest otherwise, yes.
I don't think we should think too highly of ourselves.
Because?
Because we continue to do stupid stuff, like pay attention to these, I have to come up with better words. I was going to say dumb bunnies who keep predicting things and people keep listening to them. And
gurus, can we call them gurus?
Gurus,
yeah.
But they're not gurus. They're perceived gurus.
That's true.
I mean, they're people who sell a lot of bad books with terrible advice, and then they have like the most popular podcasts, and their advice is absolute and utter idiocy. Their prediction track records are deplorable, and this one guy we're going to talk about today may have the worst prediction track record of any of them, and yet you guys have made him very wealthy by buying into his stupid predictions.
Yeah, and recently he wrote, in 2025, credit card debt is at all-time highs. U.S. debt is at all-time highs. Unemployment is rising. 401ks are losing. USA may be heading for a greater depression.
And wait a minute. Who would this prognosticator be, this brilliant
This would be
guru?
the author of the book, I guess podcast too, called Rich Dad, Poor Dad. Yeah. Somebody that we interviewed back in the old sound investing days with Paul Merriman.
Not me.
Yeah, I think you were
Was
there.
I there?
Robert Kiyosaki, I believe you were.
Did I rip him a new one? I hope I did. I
don't think so, but I had him on TV once and he was unhappy. He had a newspaper ad that said your financial future guaranteed. That's what the ad said.
Oh, sure.
So on TV I said, "Can you guarantee someone's financial future?" He said, "No, you can't do that." So I pulled out the ad, and you know what his answer was? "Oh, I didn't write that. Somebody else in our office writes that stuff. I'm not that person."
In 2002, Kiyosaki began predicting his big prediction. And he has pretty much made this big prediction every single year since, and multiple times throughout the year. And that was, he predicted that a major market crash, a country-destroying market crash, was going to occur. Started predicting this in 2002. He predicted it almost every year after. As a matter of fact, in 2011, he said that the 2008 crash, and this is 2011, that the 2008 crash was not over yet.
We're still in it.
It had been over pretty much 3 years, but it was not over yet, or 2 years. And this is when silver hit an all-time high, all-time, of almost $50 an ounce. And he predicted silver was going to $6,000 an ounce. He is still predicting, saying silver is the best investment you can make. of all investments.
It may get to 6. Just when? Inflation will take it there eventually, right?
Maybe not, because when you look back at the chart of silver,
it's taken a long time to get to this.
100 years.
Yeah.
We have, let's see, silver today is $39, and it was $35 in 1980.
Yeah, and of course, silver being the cause of the shootout at the OK Corral, which we're not going to spend time on today, but that was at the heart of that. So it's been important for a long time, Don. I think you should pay better attention to it. So,
it's important if you're mining it, I guess.
Yes, exactly, or shipping it.
It's not really even good for much.
Yeah, I'm trying to even think the commercial applications of it today.
It's a decent conductor, but not nearly as good as gold.
Yeah, okay, but let's talk about a few of the facts today, at least, right? Because we learned today, at the day of this recording, that the U.S. economy grew at a rate of 3% in the second quarter. That was better than the negative 0.5% in quarter one. Better, by the way, than the 2.3% that had been predicted. Unemployment still at a pretty reasonable level. People actually making money, depending on how they're invested, in their 401ks. But this is the problem with not just the predictions, but what do you do with that prediction, right? Because this has always been our thing. Like, okay, it looks horrible. What do we do? Well, this is the real issue with Robert Kiyosaki. He says, quote, "For those who take action today, when the crash crashes, those who invest in just one Bitcoin or some gold or some silver, you may come through this crisis a very rich person."
Mm-hmm. Assuming there's actually a crisis.
Yeah, exactly.
And that's a big assumption. As a matter of fact, when I go back and look at his track record, we can look back in 2021, he hated Bitcoin, thought it was going to collapse. Now he has had one, by the way, I did a lot of research on this. He has made one accurate prediction in the past 23 years.
Which was?
He predicted in 2025 or in 2024 that
last year
that Bitcoin would hit $100,000.
Okay.
That is his one.
But he says one Bitcoin by 2035 will be over $1 million.
See, that's where he goes a little too far again.
Exactly. So, and he does have. We do agree with him in some, even though he's a real estate guy.
No. Don't even say we agree with him.
He does say your house is not an asset, which I happen to agree with. I mean,
okay,
even though
now that's not even true. It is
an
asset.
But it isn't. It isn't something to be, I don't believe, invested in a way that's going to pay for your future.
Okay,
I think it's
I don't even think that's what he's saying. I think he's saying
not. It's hard to know.
I think Kiyosaki is saying that he's all about these hard assets. That's his new thing, and he's going to be that way until the day he dies, and he's going to be consistently proven wrong until one day he's proven right, and then he'll be proven wrong again.
Yeah, and I went and looked at a few of the reviews, by the way. The critics, they say things like risky investments for beginners. Yeah, I couldn't agree more. They chide him for platitudes versus actionable advice. And they say short on actionable advice, I think. And then another one promotes extreme conspiratorial views, impending market crashes, and reasons to get into metals, crypto, etc. So, okay, but I'm going to ask you this.
Okay.
He's not a guru, but how about what guru should you follow?
None.
Then? Oh, what about Warren Buffett?
None.
Isn't that a guru?
None. No.
Peter Lynch.
No, wait. Warren Buffett has never claimed to be a guru. That was
But can't we just give him that title?
They gave him the Oracle of Omaha moniker.
That sounds guru-esque.
It does, but it's only because he made some very smart corporate purchase decisions as a
so it
businessman.
Wasn't just investing. He ran a business.
He wasn't buying stocks to speculate on them. He was buying businesses to like he owns Burlington Northern and he's Santa Fe, and he's looking to merge that with another railroad in a smart business decision.
It made a sweet business purchase of See's Candy too, as well. If I can just put that in there. So
and a sweet purchase of Dairy Queen too. He must have had a sweet tooth.
What about Peter Lynch? Fidelity Magellan, can we call him a guru?
Well, you could. The later version of him who said, you're not going to be able to ever do what Magellan did. You might as well just buy an index fund.
I was going to get to that. Or John Bogle, can you call him a guru?
Only in that he said you can't predict the future. So yes, you could call us gurus.
That's what I was just getting to, because, yes,
we're going to predict
Lynch,
the future.
Bogle,
you can't know what it is.
You don't know what it is. So therefore, buy the market, keep your costs low, and be tax efficient. That's what those gurus would tell you. So they are gurus.
I still don't, though. I don't understand why so many people to this day continue to listen to a guy who has correctly predicted 9 out of the last 0 market crashes.
9 out of the last 0. That's a good line.
I mean, they have the line about economists predicting 9 out of the past
exactly.
5. Well,
Yeah,
he's
there you
predicted 9 out of the last 0.
I do love it. I got to say thank you, by the way, to all of you who've written in so many questions. And we're going to try to get to a few of them today, a few tomorrow, et cetera, et cetera.
Few the next
We've been
day.
trying to get to them on Saturdays, but we get so many calls now on Saturdays, it's been basically impossible
It's
to
been
break them
great.
there, so.
I mean, people from all over
I know, I
the
love it.
world are literally calling the Saturday radio show.
I love it. So let's do a few today. Rodney writes us from Oxford, Alabama. I have a new 3-month-old grandson and want to open a college 529 plan for him. I want to be the custodian and he be the beneficiary, which is exactly the right thing. Not the account holder.
Okay.
Not necessarily
It works
the custodian.
to call
Could be the place.
custodian's a
Yeah.
good word.
He lives in California. Parents plan to move to another state before he starts school, job location. Okay. I've already set up a 529 for another 3-year-old grandson with Fidelity 3 years ago. It's in the Fidelity 529 Target Date Fund 2039. I also opened a plan 2 years ago with my529.org for a 2-year-old granddaughter. It's in the Target Date Fund UTANX. Now, I looked into the Fidelity 529 Target Date Fund 2039.
Did you? Oh my gosh, the expense ratio.
I know. That's the first thing I said. I said, why in the world are you paying so much money?
No, it's time to move that 529.
Exactly. That's not a very good
Fidelity.
fund.
You should be embarrassed.
I agree, because you can get, age-based products from a variety of places. Utah would be one of them. You could certainly do at a far, far, far lower
you
expense.
Can do
good
Vanguard
diversification
there at like 5/10 or 5/100ths of 1%. And by the way, for those of you wondering, the expense ratio on this is 80 basis points, 0.8
There's
of
just
a
no
percent.
reason to pay that much in today's world.
Not that it's going to kill you to pay 80 bips, but geez, Fidelity.
Don't need to.
That strikes me as just Fidelity greed a little. I
think you may be right there.
when their
So,
competitors are charging so much less.
yeah, I think I would go ahead and move that.
Yep. Go to
Rodney.
Utah. Go to Utah.
Did
Doesn't
you look
matter
up
where
the
you
other
live.
fund? I didn't have time for this one. UTANX, the Target Date 2040-2041 fund, UTANX. I don't know that one.
UTANX. Boom, 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 boom. See if I can find. And what is it? Target enrollment 2040-2041. I'm going to have to go to Morningstar.
Yeah, I don't know that fund and I don't know that plan. But these target date funds now, there's absolutely 110% reason never to pay a commission on these, and there's no reason to pay a lot of money for them because you can get age-based. In other words, they rebalance the account to the age of the participant, and so you don't have to do any of the work. You simply put the money in there, make the contributions, they handle the rest of it. So, and you could do it at a pretty low cost today.
Yeah, this is some sort of proprietary thing because Morningstar, I can't get it at Morningstar. UTANX, right?
That's correct.
Yeah, Morningstar doesn't have it listed. It's just listed on online as a target enrollment 2040-2041.
Yeah. So, but back to your question, Rodney. No, those would probably not be products we would use. We'd recommend the lower expense, age-based that uses Vanguard or Dimensional products.
Yeah, they don't even post an expense ratio for this one.
Okay, fair enough. Cody writes us from Lincoln, Illinois. Didn't even know there was a Lincoln, Illinois.
There was a Lincoln
Isn't that
in
the land
Illinois?
of Lincoln? Yeah, there was. So, it says my job offers an Empower Roth 457 with no matching, and a $67 annual fee. I'm invested in U.S. large, which has a 0.1 expense ratio and mimics the S&P 500. A U.S. small medium, which has, I don't know if I know what small medium means, but maybe a balance between growth and value, I'm hoping. Again, 0.1 expense ratio mimics the Russell 2500, which would be, somewhere in the middle there. And international index at 0.5, which mimics the large international index. At these expense ratios and yearly fee, is it worth it to stick with the 457, or would an IRA be better? These funds do perform roughly the same as the indexes they mimic. So in other words, leave it there, pay those expenses, or move it out. Those are not outrageous expenses.
No, but if you're, since there aren't a lot of benefits and you don't have a lot of control over what you're in, if you're not putting in more into your 529 than you would put into an IRA, then maybe just do the IRA. If it's an either or.
Well, no, this is a 457 Roth.
Oh, then go with the Roth IRA.
Yeah, which you could do.
Yeah.
Now, you could put more into a 457 Roth than you could in a Roth IRA.
Right, but that's what I mean. If you're not putting more into that,
I think that's a fair way to look at it.
By the way, I want to come back to UTANX.
UTANX.
That is one of the target funds in the Utah plan.
It is. Okay.
Yeah.
So that's what he said, my 529, so I thought I recognized the website.
Yeah, so it's proprietary, apparently, within their plan.
So you can't look at the details, but Utah has a good plan. The expenses are low and the diversification's excellent.
And it looks to me like there is no expense ratio.
Well, they're charging you something. They're
Utah,
not doing it for free.
they have some fees, but I'm not finding.
Yeah, that's okay.
Well,
but Rodney, then in that case, I would simply, with the new grandchild, no reason. And by the way, having different accounts at different places makes it confusing. Just use one custodian, one plan. No reason not to. And again, unless you're getting a deduction in Alabama for keeping the money there, I would just go to the Utah plan and put it all there. Why not? That makes sense. So, Vinny writes us from Middletown, Delaware. I like your easy peasy two-fund investment portfolio, AVGE and BND. AVGE, of course, being the Avantis Global Equity Fund, and BND being the Vanguard Total Bond Fund. However, does this have enough coverage in the small cap space, only about 7%? Should I supplement this with another small cap specific fund and make it a 3-fund approach instead of the 2-fund, Don? Because that will keep Don employed as well. What do you say?
Okay. You're making it too complicated. There's a reason why we went with easy peasy. Because people don't follow more complicated strategies. They don't rebalance well with more complicated strategies. AVGE still gives you a small tilt and a value tilt that you're not getting with traditional index funds. Plus, it gives you that rules-based approach, which isn't just blindly following the index and whatever the index does whenever the index does it, which we think is an advantage over time. Worth the slightly higher expense ratio, and it is higher, but I don't know. Okay, if you buy another small cap fund, you are likely to potentially increase your long-term return by a little bit. Maybe.
I remember you already, he says 7. I thought it was a little higher than that, but because I think it's about 8%, but in small value. Now, remember, over time, yes, those assets have made more, but there are long periods where they haven't, which is recent performance.
Which is why we only want to overemphasize them, not total. If you want to go crazy, then get AVUV.
Yeah, exactly. Which we would not recommend. No. So, no, I would be okay with just having that percentage. Remember, that's more than the market is. In other words, you said overemphasize. They put more in those than if you just bought an index would, because they're saying that will outperform. So I wouldn't do it any more than what that fund is holding. No, I think you're okay there. But you're looking askance here.
No. I'm just looking at what the breakdown is on small cap.
I thought it was about 8%.
1, 2,
in
3.
Small cap value.
If you throw the mid cap in, yeah. Because they have the mid cap value ETF in there, which is close enough. That gets you over your 8. Yeah.
Yeah. All right. Thomas writes us from Spanaway, Washington. Don, suggested in one show that his position provided him free financial management service, and he was considering shifting to this approach. Let me suggest for the quality of the show and appeal to DIY listeners, that's do-it-yourself, that you continue managing your own finances while you co-host the show. Pardon me. Many times in answering questions, you talk about your current experience and working on a website and selecting mutual funds or ETF. Tom uses the company service, and that comes out when he talks about the team that's doing the research. Don, your hands-on experience brings credibility to the show. Thank you both for the program. After retirement, I started listening to 4 financial podcasts, and yours was the first and still my favorite. That is so nice to say. In other words, he's telling you, stick to your guns, keep managing your money.
I thought about it.
You're lazy. Let somebody else do it. By the way, I don't have to pay for it.
No.
So it's a pretty good deal.
No, I wouldn't either, but...
That's true.
I've done it this way for so long, it's just not likely to change. Unless I get
you
really
like
old.
Doing it, I think.
I do. I even like, redoing my
and
CD
you have that
ladder.
thing that we talk to a lot of people about.
What?
If something happens to you, guess what? Your wife can pick up the phone and get help from us. This is something people
Good
don't
point.
think about very often.
Yeah, that is a great point. As a
we
matter of
don't
fact, Debbie has an appellate advisor.
Exactly. So, and you've heard Paul Merriman, he has an advisor. I mean, really, and I have somebody here that I work with. The thing is, we should all have that person in our life because we don't know what tomorrow may bring, no different than the stock market.
Here's the thing. We know as human beings what we ought to do, but we don't always do it. I'm one of those people. I know lots of things that I ought to be doing, like Tom's always haranguing me, and my wife too.
No, I'm not your wife.
Exercise.
I don't tell you that.
You
no,
do
I've
too.
Given up. I've given up on that.
Yeah, you hint at it.
And man can only do
and
so
I don't
much.
like it. I don't want to do it.
It's hard work.
I'd rather be in my studio doing voiceover. I just finished season 3 of Mighty Man. Now I'd rather be doing that.
That's a workout in and of itself.
Mag Force Mac at your
There
service.
You go. All right.
My cartoon. I love doing cartoons.
I know you do.
I do. I really love doing cartoons and video games.
And I love watching them.
They're so. You didn't watch Mighty Man.
No, I haven't watched Mighty Man.
Your grandson should watch Mighty Man.
I think I gave it. Isn't that the one you sent me and I had them watch it or something?
don't know.
So yeah.
Mighty Man season 3 coming soon.
Get out there and
Telling
be
ya.
ready, man. I'll tell you what. So yeah.
I'm Mighty
another
Man's
question.
dad, by the way.
That's a right.
And I just found out in. Oh no, that's a spoiler. No, I'm not going to give it away.
Okay, don't tell us.
Nope. Not gonna do it.
Nate writes us from Fort Mill, South Carolina.
Fort Mill.
By the way, I'm closing in on the end
I know
of
where
Rick
that is.
Atkinson's
That
book
is a
and-
suburb
of
Charlotte, North Carolina.
I didn't realize how much of the Revolutionary War was fought in the South until I
think
read
it
the
is.
book. Let's see. So he says, I heard you talk a ton about AVUV and AVGE, but I haven't heard a comparison between the two. I understand they're both value-based funds, but under what circumstances would it be better to pick one over the other? Do they pair well together, given one is global and one is U.S.-based? AVUV and AVGE. AVUV is U.S. small cap value stocks.
Yeah,
These are small companies.
AVUV should only be a teeny tiny part of anybody's portfolio if they use it.
Well, no, these are not anywhere near. AVGE is a global
Yeah.
fund. It owns AVUV.
It owns
in it.
AVUV.
Yeah. So the short answer is there's no comparison.
Right. They're different funds.
They're completely different assets.
For different
So
purposes. For example,
if you're
let's
going
say-
to own AVGE, then you just own that. That's it.
Let's say, here's where AVUV would come in very handy. Let's say you have a portfolio at work in your 401k, and all they offer you is an S&P 500 fund. You got a nice large cap value fund. AVUV could be your adjunct to that outside of your IRA or your 401k. You could have it in an IRA or a regular brokerage account, along with maybe an international fund to give you some global exposure, and you use other accounts to create the best portfolio, and that's where
Exactly.
AVUV would come
It's
in
more
handy.
work.
It's more work.
Yeah. And by the way, I think you can go online. You've done this. I believe you can go look at AVGE and see what the percentages of each of the ETFs that they own in
I
AVGE.
just did that just a few minutes
so
ago.
if you want to get fancy and you want to own all those funds and rebalance them yourself and do all that work, go right ahead.
Well, let me see how many are in there.
That's not the point of doing AVGE.
I think it's
Is
12
it 6
or 13.
or 7 or
no,
something?
it's more.
Really, that many? Wow.
It is, ready, just for everyone's edification.
Yep.
The largest portion of the portfolio is in their U.S. equity ETF, then in U.S. large cap value, then in international equity, then emerging markets, then in international large cap value, international emerging markets value, U.S. small cap value, U.S. small cap equity, U.S. real estate, U.S. mid cap value, U.S. mid cap equity, international small cap value, international small cap equity, and emerging markets small cap equity.
That's a ton. That's a ton of asset classes.
That's 15 funds.
But again, back to the question: if you own AVGE, you don't need to own anything else because it's already in that fund for you.
In
One
a
fund.
reasonable proportion that will
And at
be
a reasonable
maintained.
cost.
That will be maintained, by the way. So the rebalancing will be done for you.
Correct. And it's done. It's like 23 basis points or something, 0.23. It's a very reasonable cost. So
It is cheap. I think it's 23.
0.25. It's
2.3. You're right. You were right.
It's pretty small. So that would be a good one. Yeah, I'm in agreement. That's all the time we have for questions, but we're going to do more tomorrow, right?
Well,
Got
not
more
tomorrow.
questions.
It won't be tomorrow. No, it'll be.
There's
let's
not.
see.
There's no tomorrow. You're
It'll be-
telling us that. I thought you didn't know the future.
It'll be Monday. These recorded podcasts play on Mondays and Thursdays.
Ah, okay.
Just so everyone knows the schedule. Here, you can. I'll tell you the schedule.
You'd have to send it to me
No,
by
no,
email.
no, no,
and
no.
I have to read it a few
Okay,
times.
Mondays and Thursdays come from our
Mondays.
recording, like we're doing right now, Tom. Okay,
Correct.
Monday and Thursday.
Yep. Okay.
Tuesday and Wednesday come from
That comes from the Saturday show.
Saturday show.
Ah, look at that. I
Congratulations!
got that right.
No, I knew you could figure this out, and you don't even have to touch a button to do it.
No
Wait,
button
now
touching.
Friday is what? You know this too.
The last day of the week.
What is the topic on Friday?
Friday's my favorite podcast of the week. That's the one you do by yourself.
Or
When you answer
it's
the
you and
question.
Roxy sometimes.
Yeah, but
Friday
I love that
is
one.
Q&A
My
day.
grandsons love that one. If they get in the car and they're not hearing you, they always go, "What happened to McDonald?"
What happened to, and they do. They call me McDonald.
They say, what happened to McDonald?
What happened to old McDonald? Well, he's at the farm. E-I-E-I-O.
He bit the farm apparently.
apparently.
So, yeah. No, we love Fridays. So okay, thank you.
See,
for
now you
all
know
that.
which is which.
I do. And Saturday is the live show for those of you who want to hear it,
On-
and you can hear it anywhere in the country.
Anywhere in the world.
We have people. By the way, there was somebody here in the office that just talked to a 20-year-old from Ireland who listens to the podcast and wanted some help.
As a matter of fact, I think you can even listen to it at talkingrealmoney.com.
Ah, I didn't know
I think
that.
there's
You
a
can?
link. I'm pretty sure
Oh.
I put one in there. I'm a very helpful person. There it is right there.
So
You can go to talkingrealmoney.com and
Yeah.
scroll down below the podcast, and there's a button that says listen live.
I love it. So tune in, turn on, and drop out, whatever Timothy Leary said. So
Wow. You are showing
Isn't that
your
what he
age.
said?
You are showing your age.
as long
Don't
as I didn't do what he did, I'll live longer.
don't touch the buttons.
Oh, please.
And none of you, don't touch that dial. Okay, it's not really a dial. It's like a podcast thing. And by the way, most of you, we know which podcast service almost all of you use. You're all Apple Podcast people.
Tell some people at Spotify to tune in.
I mean, we have 40+% of our audience is Apple Podcasts, and 17 is Spotify.
which is, I think, a bigger service now, right?
About the same.
Okay.
About the same. But I
If
think
Spotify,
I think
tell your friends.
Spotify skews younger.
Well, that would be the reason that Apple has more.
Exactly. So,
thank you for listening to us in Ireland and China, because we get a lot of.
Do you
people
have
in
any other
China
messages you'd like to share
listening.
with our
The
audience?
only other message is, if you want help, let us know. And we talked to a lot of people this week, so
Tom is
you need
really
help.
busy.
it is. I'm busy, which is fine because it keeps me out of pushing the buttons, and I'll blow something up.
Yeah.
So that's good. Yeah.
Or telling me to exercise. And thanks for being there. If you want to call us on Saturdays, 855-935-TALK is the phone number. If you want to send us questions, go to talkingrealmoney.com, click on the Contact Us button, and either speak it in or type it in. And please be sure to tell a friend that we are here, wherever here might be, and here is so many places, but we are here or there talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.